discussing our essay, I Was on Top When This Shit Meant a Lot. It's a review of our last year. It's also an allegory to a song by Drake. So we're using kind of a bridge here, hopefully getting across in a poetic way what happened last year. I was on top when the shit meant a lot. This is the review. It's an essay. It's also a review. The purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. We have a tough time right now. Orange Capital Partners is pretty much being decimated because our largest position, Tesla, is suffering, and we are suffering, and it's showing in our P&L. And I don't want to mince words here. So the title of the essay is, again, I was on top when the shit meant a lot. I'm going to discuss it. I'm going to discuss what we're writing in the essay. We're basically trying to understand the mechanics of financial markets from an engineering perspective. This is the key. Once you understand how it works, you then understand what are the driving factors, and then you relate those factors to your positions, and then you see what's going on. And it helps understand what's going on. It's not going to guarantee you returns or anything like that, but it's going to make it easier to isolate what it takes to make money in the financial markets. And this is really our job. This is our job as hedge fund managers, and it's also our purpose in this podcast to give people a sense for what it feels like to run a hedge fund. This is not even wrong podcast. It's January 3rd, 2023. This is Krim Delco. For the day, we're down 12%. The market's down 1%. We're underperforming by 11%. The reason we had a massive underperformance today is because Tesla came out with their delivery numbers for Q4 and the production numbers. Production was okay, 437,000. It's roughly in line with what people expected. People were kind of in the 450 range, but that's okay. The problem is the delivery. The delivery came in at 405,000. That's way below the production, so there's an inventory increase. There's a little bit of concern about demand now. Now, we have done quite a bit of work on this. Here's our take on this. It's almost exclusively a China problem. And the China problem is, in our view, the following. The country has been in lockdown. So it has been functioning in complete lockdown, which is actually amazing that they've been able to do this. However, they then opened up, which I think was overdue. People were rebelling. People were scared of being locked down and had it basically. They wanted to open up, be a little bit more free. Maybe not free in a sort of Western way, but free, live their lives, go and pursue their lives and all that. What that created then is, of course, a massive, massive change in behavior and a scare. The scare is, am I going to get sick? Am I going to get COVID and all that stuff? So, look, we're not on the ground, so we can't sit here in Los Altos and argue about a 1.5 billion country of people of 1.5 billion with dictatorial regimes and corruption, and God knows what's going on there. But fundamentally, we believe, here's the thing, we believe that the China problem is real, that Tesla has a demand problem, and that will mitigate itself now with the opening up of China. We actually believe China will be the big surprise this year. Now, it still can go two ways. It can completely collapse into a totalitarian nightmare, or it can get back to normal. Back to normal is already a massive, massive plus. I mean, if China gets back to normal, which means, let's say if you had real economic growth of 4%, and you get back to 2% from negative, which I would say, Chinese economic growth is probably negative, real economic growth, not the statistical, propagandist type, but the real activity on the ground, because people were in lockdown. For God's sake, they couldn't do nothing. So getting back to normal, people opening up their shops, people going to work, people getting their kids to school, the teachers, the mothers go to yoga classes, all that stuff, normal life goes back, at least in the big cities. I don't know about rural China. The point here is that we should have some sort of normalcy. And in a normal time, China does maybe 19 million cars. Tesla can do 1 million cars. They can have very large market share because electric cars are very popular, because Tesla is very popular, because Tesla is very competitive. This is a conjecture. 1 million cars in China this year. That's what we project. We project 600,000-700,000 in the US. We project about 400,000 in the rest of the world. So let's say 2 million cars. We're going from 1.35 to 2 million. That's roughly 50% growth. We're projecting at least $5 a share, probably even more if our projections on delivery are right. Now, they have, of course, if they have 50% volume growth, they're not going to have 50% top line growth on the car side, just simply because ASPs have to come down. That's another thing we're going to discuss quite shortly. But we also think that the energy business can start contributing. So we think that we can actually have 50% top line growth, and we can have in the sort of 60-70% EPS growth. So that means that we can do a lot more than the 350 that we project this year. So if we have 50% growth, that will be sort of something in the 520 range. If we have more than that, then you know it will go much higher. Now, here's the thing. If these numbers happen, the stock makes absolutely no sense where it is right now, and we should have a massive rally. At least double, if not more. Maybe not back to the all-time highs. The all-time highs were driven by you know, interest rates and stuff like that. But here's the point. And now I want to talk about the essay. I want to talk about the essay. Actually, I'm sorry. Let me finish the discussion of what happened today. So we had these bad numbers, and the market is selling off. Why? Because now we have demand constraint. We have demand concerns for the 2023. We think that those demand concerns will be mitigated, in particular by the China recovery and also by lowering prices. Tesla has to lower prices. This is it's not just because we want them to lower prices because we're consumers. As investors, we want Tesla to lower prices because Tesla's win is going to be through the cost structure. And raising prices because of inflation, it's an excusable mistake, but it has to be reversed. So Tesla needs to lower prices fast, and in one shot, the 3 should be in the high 40s and the Y should be in the mid 50s. So they should actually qualify for the tax situation with Biden. That's a whole other conversation. It's appalling to me what the Biden administration is doing and the IRS. It shows how corrupt Washington is, but it's okay. There's a thing about the government, which is the government tries to do things and is very slow. Companies adapt much faster. As bad as the government is in solving problems such as healthcare or safety, that as bad they are in trying to hurt a company. Because it's like you have this sloth trying to attack this 100-dash Olympic winner. I mean, the company you're trying to attack is so much faster and so much agile. By the time the bureaucrats in Washington figure out what's going on, you're already 5 steps ahead. What Tesla's going to do is lower price. They're going to throw in some software. They're going to, you know, bundle stuff. They're going to make this so compelling that whoever is trying to take advantage of this ridiculous tax credit that is passing or might be passing, has been passed. I don't even know what's going on. But nevertheless, there is confusion right now. There is an EV tax credit that, of course, everybody is getting except Tesla, which is the only EV company that really matters. It's absolutely appalling. It's corruption at the highest level. Biden, who's some sort of, you know, mafia boss, Pennsylvania mafia boss. I mean, this is like the Irishman in real time. It's terrible. Nevertheless, we're okay with that. We think it's going to be mitigated by lowering the price. This is what needs to happen. Now, as I said, we had a bad start, but that's okay. These things happen. We'll be fine. Let's talk about the essay in last year. So I was on top when the shit meant a lot. Shit replaced shit with future. When the future meant a lot, we were on top. Now let's get back to the mechanics of the stock market and discuss our essay. The essay basically discusses our year and then goes back to the origins of financial markets, which is the invention of stock markets in Amsterdam in 1602. And we're telling a short story about Louis Colbert, who is a fictional character, who is the first investor who generates wealth as an investor. There's a couple of things that happened in Amsterdam in 1602. One is the limited liability joint stock company was invented, meaning a company that has a legal entity and its investors, its owners, have limited liability. Second, the company issues shares that the owners can buy, and the capital that the company requires to do business is provided through the share sale, and the shares can be traded on the market. This is the big invention. Two inventions: limited liability, shares traded on the market. There were shares before, but there was no limited liability in that sense. There were limited liabilities in let's say in Italy, in the city states like Florence and Venice and stuff. They had similar things, but in the end, if you screwed up, they went and got your house. In this case, it's a complete virtual entity called the Limited Liability Joint Stock Company. The first one, the Dutch East India Company, which was the first and actually only company which was traded on the Amsterdam Stock Exchange for years. The reason they had to do this, which is interesting, and this is something just I want to sort of mention to the crypto crowd here, is a little bit here. We had these inventions in Amsterdam in 1602, and it's really important to understand that inventions came to solve a problem. So the stock market was not invented, and the limited liability company was not invented just because it was cool, and then we were looking for a problem to solve with that. It was the other way around. We had a problem, which is we had a company that was going to do business in the East Indies, which is modern Indonesia, and they couldn't finance it because the Dutch aristocracy wasn't rich enough. And on the other hand, also the Dutch had some experience in communal finance, which is building dams and things like that. So somehow they came up with these unbelievably interesting concepts: limited liability, joint stock company, and shares, and then trading and all that stuff. So why did I mention the crypto crowd? This is tangential. I'm just saying crypto is very interesting. The problem is we don't have a real problem to solve yet. So we're building all this infrastructure for crypto exchanges and all that stuff and NFTs, but we don't have real problems to solve. Now, the hope is that somehow something will happen, fine, but I am just of the opinion that real technology, real wealth creation always happens by solving a problem and not by creating technology and then looking for a problem. This is just sort of tangential. Let's get back to the essay. So this fictional character, Louis Culvert, we're sort of following over 20 years, and he becomes one of the wealthiest one of the wealthiest families in Europe, and through investing. So we follow him through his thinking process of why should he invest in the Dutch East India Company. There are good times and bad times. There's valuation issues. There's the sort of relative investing relative to things like sovereign debt. So he goes through all of these thought processes, and there's times when the shares go up a lot, there's times they collapse, and we go through all of this. And we isolate the three vectors of wealth creation. The three vectors of wealth creation: one is it's the interest rate, second it's the future prospects, and third it's competition. Those are the three vectors of wealth creation. If you want to create wealth in the stock market, you gotta focus on those three things: interest rate, future prospects of the companies you invest in, and the competition that the companies face. The interest rate is the easiest one the interest rate is like gravity, okay? And when we actually talk about interest rate, what we talk about is the risk-free rate. This is a construct that we created in this Keynesian 20th century type finance world. It doesn't have to be like that. If we had an Austrian economics background, if the world was more Austrian, which means we don't print money, we have something like Bitcoin or gold, then interest rates wouldn't matter that much because they would be close to zero. However, because we don't have that, we have a Fed, we have Federal Reserve, we have money printing, interest rates fluctuate, and it's pretty complicated. So we have this interest rate factor. But the point here is the following, that interest rate is like gravity in the sense that if it's very low, then other asset prices can inflate, and if it's very high, then other asset prices, they deflate. This is just, it's kind of like a financial law of physics, if you will. So that's the one thing. We look at the multiple of Tesla. In the beginning of the year of 2022, the multiple of Tesla was around 100, meaning the earnings expected in 2022 were 350. They're actually going to print probably 355. So they did a little bit better than what was expected. But at the beginning of the year, with the same earnings, the stock was trading at around 100 times earnings, and it collapsed to about 35 times earnings. So it's a 65% decrease in multiple, which is almost all explained through the interest rate, because the interest rate went from, the 10-year went from 1.5% to about 3.8%, the 10-year treasury. You can look at the Fed funds rate, 10-year treasury. These are all very similar indicators. So what does that mean? That's very important. It means that a lot of the sell-off, a lot of our performance has been driven by interest rates. And this is a big lesson that we also have to learn, that no matter how much work we do, no matter how much specialized company research, fundamental research, all of that stuff we do, in the end, we're so much more driven by interest rates than we think. Lesson number one. Lesson number two, the future prospects. I was on top when this shit meant a lot. So we have to be very, very concerned. We have to understand how the future of a company changes. It might sound a little bit like an oxymoron. How can the future of the company change in the present? What does that mean? Well, it's the future of a company is the collective imagination of the management, the employees, and the investors, the owners, the media. So the future of a company is really what we think the company can do. It starts with the CEO, Elon Musk, and then it goes down to the employees and us and investors and media. And that changes. It goes from they can do robot taxis and all that stuff to, oh my gosh, they can't even sell cars. This is what's happening. You can argue it's good or bad. Now, I want to be very clear. Like I said in the beginning, I think most of the sell-off is driven by interest rates. It's not that the future prospects of Tesla are much worse than they were before. The market is not pricing that. The market is pricing simply, given the alternative that I have, the risk-free rate, I prefer not to invest in Tesla right now. I think it's a mistake because I think interest rates will plateau. And I think the prospects of Tesla are still very good, if not better. And part of the reason is the third, which is competition. Now, what does competition mean? Competition means that, and this is Peter Thiel, classic Peter Thiel, which is you have a large market, alpha, and delta is the piece of that market that you can get for yourself and for your own shareholders. Alpha times delta is really what drives wealth. You can have a large market, like you can be a utility, you can be a beer company, you can be all these companies, a meat company, supermarkets, they all have large markets, but they can't get a big share of that market because their delta is very small. Why? Because competition. How do you create a large delta? Well, that's what disruptive innovation is all about. This is Jim McKelvey, the innovation stack. What does it mean? It means that through continuous iteration, error correction, iteration, error correction, error making, error correction, you create a moat that is so hard to penetrate that nobody can compete with you. Disruption, we discussed this in several essays and also, of course, podcasts. Disruption is really, the definition of disruption is when the incumbents don't care. That's what disruption is. And why don't they care? Because they don't know that something's coming, but they also can't compete because of the cost structure. And the cost structure is driven by disruptive innovation. So these are all related things. You can't have a disruptive company with a high cost structure. Why? Because if you do something, you have a high cost structure, somebody else comes in, takes you out. By the way, that's why Tesla had to go to China, not to cater to their market. That's a nice side effect. The reason Tesla had to go to China is because that's where the main competition will come from in luxury electric autonomous cars. That's it. That's why they had to go there and compete. And hopefully at the Investor Day next in 3 months, we will get an introduction of the new platform, the lower cost platform, and hopefully that is the fruits of all this work that Tesla's doing in China, which has really become a cost competitive growing company that nobody can get at you. Even now, look what Biden is doing with all this EV tax credit. Tesla has a superior cost structure, on top of that superior value, because the game in disruption is not just lower cost, of course. You don't want to just, you want to have the highest possible ratio of value to total cost of ownership. Okay, value is, let's say, alpha, and total cost of ownership is gamma. Alpha divided by gamma. You want to make that as high as possible. You want to deliver as much value at the lowest possible cost of ownership for whatever you're providing, a car, an insurance, a rocket, whatever it is. That's what successful wealth creating companies do. And Tesla is one of them. So we finished the essay we finished our fictional story, Louis Colbert. He's now an old man. His sons took over. He's one of the wealthiest people in Europe because of investing. And he taps on the shoulder of his son, Johann, and he says, we each get one opportunity to generate wealth in our lifetime. Mine was the Dutch East India Company. What's yours? That's how we finish the story. And this is so, so important because it applies even today. We all get one shot, maybe two, because innovation now goes faster than in 1602. But I still believe that it's only one shot. Why? Because even if there are maybe two companies in a generation of investors, you usually miss one of them. You don't see it. But that's another whole podcast. Let's just leave it at that. There's one shot. You get one shot to generate wealth. Which one's yours? Ours is Tesla. Why? Because the three factors of wealth, the three vectors, the one is interest rate. Well, we can't do much about that, but that's fine. We're okay with that. The two others, the cost, which is the competition, and the future prospects. Future prospects are amazing, and competition, which is driven by the cost structure or that ratio of total value, of value delivered to total cost of ownership is the highest. As long as that ratio is very high, as long as the prospects will be very good, and if interest rates plateau as we think they will, then we can see Tesla back into the 30 to 50 times earnings, and if earnings grow at 50%, then we can have a very, very good performance. We might have a very sharp recovery this year, and then we could just keep growing in the sort of between 30 and 40%, which of course is more than enough for our purposes. So to summarize, I was on top, but this shit meant a lot. This is the title of our essay, which also summarizes our 2022. It was a tough year for us. We lost money, we lost reputation. We're going to come back, and the way we come back is by understanding the fundamental mechanics of financial markets and then apply it to our largest position, Tesla. We believe Tesla will recover because China will recover, because Tesla has the highest value divided by the lowest total cost of ownership. So that ratio is the highest within the markets that Tesla is competing in. That's why Tesla will succeed. We believe that Europe will ramp up, that US will be fine, and that China will recover, and therefore we'll have earnings growth, we'll have total top line growth. On top of that, there is the energy business, which people are completely forgetting right now, which is also incredibly interesting.